All right, let's talk Copart's latest earnings. When you really dig into their Q4 and full-year results for 2025, one thing just jumps off the page, and that is the raw power of their pricing.
So, what's the big headline here?
Well, it's kind of that classic Wall Street story, a real split decision. On one hand, you've got a fantastic, confident beat on profit. But on the other, a tiny little miss on revenue. Let's put some numbers to that. So their GAAP earnings per share, 41 cents. That's a solid 4 cents better than what everyone was expecting. Nice. But then you look at revenue, $1.125 billion, and it just missed the mark by about 21 million. So you got to ask, right? How in the world do you beat on profit when you miss on revenue? And the answer, as it almost always is buried deep in the details. You got to look at how pricing, profitability, and volume are all playing together. And man, this is where you really see the Copart business model flex its muscles.
Okay, check this out. This is the heart of it. Their U.S. insurance average selling prices, we call them ASPs, they shot up 5.7% year over year. And get this, management made a point to say that this growth crushed the big used car indexes like Mannheim. I mean, that's just pure, unadulterated pricing power. And what does that pricing power get you? Well, it flows right down to the bottom line. It pushed their gross margin all the way up to an incredible 45.3%. See, when you can charge more, you make more. It's that simple. And that is the secret sauce behind their earnings beat. But there's always a but, right? Here's the other side of the coin, and it's why they had that little revenue mess. Their U.S. insurance volume actually dropped by 2.1%. Now, management said this was mostly due to some weirdness with insurance carriers and, more uninsured drivers on the road right now. Hold on, though. There's a really important piece of context here we can't just gloss over. Copart's been making a smart strategic move, shifting their lower-value cars to this thing called direct buy. It's like a peer-to-peer system. It's way more efficient for them, but, and this is the key part, those sales don't show up in their main units sold number. So if you adjust for that, the decline wasn't 2.1%. It was actually just a tiny 0.6%. See? Way less scary. So you've got this amazing pricing power, great margins, and some clever volume management. And it all comes back to one single thing, Copart's massive competitive advantage, what they call their auction liquidity. So you're probably hearing that term, auction liquidity, and wondering, what the heck is that? Is it just some corporate buzzword? No, absolutely not. It is the literal engine that makes this whole company run. CEO Jeff Leo said it perfectly on the call. He said, the critical value we provide sellers at Copart is that our auction platform will find the highest and best use of every vehicle anywhere in the world. That's not just some slick marketing slogan, folks. That is the very reason they have so much pricing power. And how do they do it? It's all about their global reach. Get this. About 40% of all the cars they sell in the U.S. get snatched up by international buyers. Think about that. You've got this massive global bidding war happening on every car, creating this insane level of competition that no local or domestic-only auction house could ever hope to match. Okay, so that's the picture right now. But if you're thinking about Copart for the long haul, the really exciting part isn't just this one quarter. It's the huge long-term trends in the industry that are basically acting like a giant tailwind pushing them forward. And the big one is called total loss frequency. It just keeps ticking up, and it recently hit 22.2%. It's pretty simple, really. Cars today are just jam-packed with complex tech, which makes them crazy expensive to fix. And for Copart, every car that an insurance company decides is too pricey to repair, well, that's another car for their auction. And EVs? Oh man, EVs are just throwing gasoline on this fire. Even a little fender bender can wreck a whole bunch of super expensive sensors, cameras, and all that fancy stuff. The cost to just recalibrate all that tech can be astronomical. Often it's enough to total the car right then and there. This isn't a short-term thing. We're talking about a huge tailwind that could last for decades. And they're not just sitting back, right? Copart is jumping all over AI to take advantage of these trends. They're using it to help insurance companies make those total loss decisions almost instantly. They're using it to suggest cars to buyers and even to speed up boring but critical stuff like getting the car title sorted out. This isn't just tech for tech's sake. It's making them faster and more efficient. Okay, team, let's pivot to the next call. After digging through all this, my rating on Copart is a clear outperform.
That pricing power is just too strong to ignore. The volume issue looks temporary, and that long-term story, it's as solid as a rock. Now let's have some fun. I've got a couple of trade ideas for you, maybe a little wild, but totally plausible.
First idea. This one's a classic pairs trade, and it's a direct play on the tension that's baked right into the auto insurance world.
Here it is. You go long Copart, and at the same time, you short a basket of auto insurance companies. The logic is just beautiful in its simplicity. Everything that's squeezing the insurance company's profits, the rise in complexity, the crazy repair costs, that's the very same stuff that feeds Copart's business. The more cars the insurers have to write off as a total loss, the more business Copart gets. It's a perfect hedge.
All right, for all you options traders out there, I've got another one. This is a bit more structured, and it's all about betting on a specific company's execution versus the market as a whole. So the idea is you buy call spreads on Copart, and you pay for it by selling some out-of-the-money puts on a broad infrastructure ETF. What's the thinking here? Well, you're making a very specific bet. You're betting that the value Copart creates from its unique physical infrastructure, all those salvage yards, will outperform the general infrastructure market, which might face some headwinds. It's a clean bet on Copart's ability to execute. So, let's wrap this up. The bottom line is Copart's pricing power is just phenomenal. It's more than enough to handle a little short-term weakness in volume. And those long-term tailwinds we talked about, they seem to be getting stronger, not weaker. Now, of course, you know the drill. This is not financial advice. Please always do your own homework.